Imagine this for a moment. You are 71 years old. You worked hard your whole life. You saved carefully. And last year, your financial advisor told you to do something smart. Convert part of your traditional IRA into a Roth IRA. You did it. You paid the taxes. You felt proud. Then the letter arrives. It is from Medicare. And it says your monthly premium is going up by more than $400 a month per person for the entire year. You sit at the kitchen table. Your hands are shaking. You read it again. There must be a mistake. You already paid your taxes. You already did everything right, but there was no mistake. You just walked straight into one of the most painful and least understood rules in the entire United States tax code. And by the time most retirees find out about it, it is already too late to fix. Hello, my friend. I am June, a senior policy analyst who has spent years helping retirees just like you understand the complicated rules that quietly drain retirement savings. I am here today because there is an IRS rule that destroys Roth conversions every single year, and most retirees never see it coming until the damage is already done. In the next few minutes, I am going to walk you through exactly what this rule says in plain English. I will tell you the 3 steps you must take to protect yourself, and please, stay with me until the very end, because there is one hidden mistake that retirees make that can make this problem permanent. You cannot undo it, not ever, and I want you to know what it is before you make a single move. So please, sit down with a cup of coffee, take a deep breath, and let me tell you about Robert. Robert was 68 years old, a retired electrical engineer from Ohio, wife named Linda, 2 grown children, a paid-off house, and about $600,000 in a traditional IRA he had built up over 40 years. Robert was a careful man. He read the news, he watched financial videos on YouTube, and in late 2024, he heard the same advice over and over: do a Roth conversion. Pay the taxes now. Enjoy tax-free growth forever. Leave a beautiful legacy for the kids. It sounded perfect. So in December of 2024, Robert converted $120,000 from his traditional IRA into a Roth IRA. He paid the federal taxes. He paid the state taxes. He felt good about it. Then 2026 arrived. In January, Robert opened a letter from the Social Security Administration. His Medicare Part B premium had jumped from the standard amount to over $390 a month. Linda's premium jumped too. On top of that, their Part D prescription drug coverage now had an extra surcharge attached. For the year, Robert and Linda were going to pay almost $10,000 more in Medicare costs, just because of that one conversion. But it got worse. When Robert sat down to do his taxes, he found out that because his income spiked, 85% of his Social Security benefit was now taxable. Money he thought was safe, money he was counting on. And the worst part? Robert called his advisor and asked, "Can we undo it? Can we reverse the conversion?" The advisor was quiet for a long moment. Then he said, "Robert, I am so sorry. Since 2018, you cannot undo a Roth conversion. Ever. It is permanent." Robert sat in his kitchen, just like maybe you are sitting right now. He had done everything the videos told him. He had followed the rules. But nobody had told him about the IRS rule that was about to cost his family more than $15,000. That rule is what I want to explain to you right now. So let me break this down for you simply. There are actually 4 parts to this trap, and I want you to understand each one. The first part is what the IRS calls the Roth Conversion 5-year rule. Now please listen carefully, because almost every retiree gets this wrong. There are actually 2 different 5-year rules in the Roth IRA world. Most people only know about one. They think they opened a Roth account years ago, so they are safe. But the IRS, in Publication 590B, is very clear. Every single conversion you do starts its own brand new 5-year clock. If you do a conversion in 2025 and another one in 2026, those are 2 separate clocks, 2 separate timers, and the IRS counts them independently. Now here is the good news for most retirees. If you are over 59 and a half, you are protected from the 10% early withdrawal penalty on the money you converted. That is the safe harbor. But the earnings, the growth on that converted money, still has to wait through its own 5-year period before it is truly tax-free. The second part of the trap is the one that ruined Robert's year. It is called the irrevocability rule. Before 2018, if you did a Roth conversion and changed your mind, you could undo it. The IRS called that a recharacterization. But then Congress passed the Tax Cuts and Jobs Act. And starting January 1st, 2018, the IRS made it crystal clear in its official FAQ. A Roth conversion can no longer be reversed, not if the market crashes, not if you owe more tax than you expected, not if your Medicare premiums explode, not for any reason at all. Once you convert, it is final, forever. The third part is what they call the Pro-Rata rule. This one catches people who have both pre-tax and after-tax money sitting in their IRAs. Many retirees believe they can convert only the after-tax portion and avoid the tax bill. The IRS does not allow that. Under Internal Revenue Code Section 408, the IRS adds up every single traditional SEP and simple IRA you own, treats them as one big bucket, and forces you to pay tax on a proportional share. You cannot cherry pick. You cannot separate the accounts. The IRS sees one pot of money. And the fourth part is the silent killer. It is called IRMAA. That stands for the Income-Related Monthly Adjustment Amount. According to the Medicare 2026 Cost Fact Sheet from Medicare.gov, your Medicare Part B and Part D premiums are based on your income from 2 years ago. For 2026, the IRMAA surcharge begins when a single person's income goes above $109,000, or $218,000 for a married couple filing jointly. And here is the cruelty of it. $1 over the threshold. Just $1. And you pay the full surcharge for the entire year. That is why Robert got hit. His conversion pushed his income over the line. By the time the bill came due, it was 2026, and there was nothing he could do. Now, there is one more thing I have to warn you about. If you are 73 or older, you have to take your required minimum distribution from your traditional IRA before you do any conversion. Per IRS Publication 590B, you cannot convert an RMD. If you try, the IRS treats it as an excess contribution and charges you a 6% excise tax every year until you fix it. Please remember that one. Now let me tell you what to do. 3 steps. Write them down, save them, share them with someone you love. Step 1. Before you do any Roth conversion, go directly to the official IRS website at irs.gov and read Publication 590A and 590B. Look up Form 8606. That is the form that tracks your basis and protects you from being taxed twice. Do not rely on what a YouTube video says. Do not rely on what your neighbor says. Go straight to the source. The IRS publications are free, and they are the official word. Step 2. Before you convert one single dollar, calculate the impact on your Medicare premium 2 years out. The IRMAA threshold for 2026 is $109,000 for singles and $218,000 for couples. Add your Social Security, your pension, your interest, your dividends, and your planned conversion. If the total puts you anywhere near that line, you must either reduce the conversion amount or spread it across multiple years. This one step alone could save you $10,000 or more. If you have already had a life-changing event like retirement, you can also file Form SSA 44 with the Social Security Administration to request an IRMAA reduction. You can find that form at ssa.gov. Step 3. Keep every single document, every Form 1099-R from your IRA custodian. Every Form 8606 you filed, every confirmation of conversion, every Medicare letter, put them in a folder, label it clearly, because if the IRS or Medicare ever questions your numbers, those documents are your only defense. And if your custodian reports something incorrectly, IRS Publication 590B explains how to correct it with a written explanation and a corrected Form 8606. Now, before we finish, I promised you one hidden mistake. Here it is. The biggest mistake retirees make is converting too much in a single year because someone told them to fill up the bracket. They listen to general advice that does not consider their specific Social Security, their specific Medicare situation, or their specific state taxes. They do one big conversion in December, feel proud of themselves, and then in 2 years they get hit with an IRMAA letter that drains their savings. And remember, because of the 2018 tax law, they cannot undo it. The conversion is permanent. The damage is permanent. The lesson costs them $10,000 or $15,000 or even $20,000. Small conversions over many years. That is the safer path. stay below the IRMAA cliff. Coordinate with your tax preparer, and never ever convert in December without checking your full year's income first. My friend, I have to be honest with you. The rules around Roth conversions, Medicare, and Social Security change every single year. The IRMAA thresholds change, the tax brackets change, the RMD ages change, and the IRS does not send you a friendly reminder before you make a mistake. Please do not depend only on YouTube notifications for these critical updates. Notifications get lost, algorithms change, videos disappear. Your retirement is far too important to leave to chance. Bookmark IRS.gov, bookmark Medicare.gov, bookmark SSA.gov. Visit AARP.org once a month and read their retirement updates. And before you make any conversion, any rollover, any major financial decision, talk to a qualified tax professional who knows your full picture. If this video helped you understand the Roth conversion trap, please share it with someone you care about, a spouse, a sibling, a neighbor, because one conversation today could save someone you love thousands of dollars tomorrow. This is June from Retirement Tax and Law Pro. Take care of yourself, take care of your money, and I will see you in the next video.